Hey, everybody. Welcome to Market Mavericks. The tripod is back to brace you guys for the craziness that is in this market right now. So every week we're something different here. But how are you gentlemen doing today?
Good. Hello.
Good,
Great.
good, good. Awesome. So where do we start today? Should we start with some of the economic data that recently popped up? We got jobless claims this morning. They were a little bit less than last week. I guess starting with that, we had 222,000 jobless claims. Last week was 232, but prior it had been like 208, 210. Is this a beginning of a trend change? I mean, are you guys seeing that the economy is starting to slow finally?
Well, I am, but I did a year ago, so I have to, I have to bite my tongue, and it's the cool thing about markets. If you're not humbled by them once in a while, you will be
That's
humbled by them in a big way. So, yeah, to me, this is the big picture, the massive, significant delay. That's one thing we learn in markets is delayed reactions are the worst, and I think it's just going to make everything worser. And I'll show you a chart on that, and I start with thing that's really struck me over a year ago, and that's retail sales. You take retail sales minus CPI. I mean, it's as bad as it was right around the recession I remember well was with the dot-com bust, which was in 2000, 2001, 2002. Retail sales are negative minus CPI. So that kind of, it's not good. And then everybody tells me it's all about services. I'm like, yeah, okay, I remember hearing that. And the key thing is rates are real high and leading indicators are starting to shift. They're maybe getting worse, a little bit better, but overall, the signals here are just really bad. The thing is, we've been have an inverted curve now for almost 2 years. And that's almost the longest time in history without this recession. And the key question you ask yourself at some point, does it matter? And I think the thing is, it's going to be the worst case, is it's going to be worse than ever. And I want to show you a chart on that really, that I'll if I can find out which one it is. This one. See this? That's significant. I pulled up this chart on the global curve. What I show you in white is, do you take the Fed funds rate and just I'm sorry, take 10-year, the average of 10-year note yields in the top 5 countries in the world, and take out and subtract Fed funds. So everything in the world, their 10-year note yields versus Fed funds. And this is what you get in this white chart. It's the most inverted in my database. I'm going to go back to 2006 on this, 2007. And I overlay this with commodities and S&P 500 on the same scale. And to me, it's just like, this is an action. This is an indication that all we're going to need is a little bit of a catalyst and the dominoes should tumble. That's if you, like me, you really believe that bonds tell the truth.
Does this chart where the inverted world yield curve is this much inverted, does it tell us how bad it could be? Like, is there a correlation between how deep it is and then how bad the world recession or the U.S. recession could be?
In a way, I think it's going to be the worst ones of our lifetimes, and it makes sense because we just had one of the most combination of the lockdown, the most significant events in 100 years, with that Russians, invasion of Ukraine, the unlimited friendship, all that kind of stuff. To me, the significance here, it shows you all the main things, problems in the world. Fed funds are high at 5.33%. They can't go down because U.S. inflation is sticky. It's keeping the dollar strong, and the rest of the world is, in terms of bond yields, are collapsing. Now, China's cutting rates. ECB is going to cut rates next month. UK might cut rates. A lot of other countries, even Brazil, starting cutting rates, but they can't cut too much because their currencies will collapse. It shows you to me, the train wreck that's happening in the U.S. You can't cut rates until inflation's low, and that's why problem is I don't think inflation is going to go down until the stock market goes down. Partly because of what I show you on this chart here is just if you look at the S&P 500, I go back since 1928 on this one. S&P 500 versus gold. It's 2.2. S&P 500 versus GDP in trillions times 2. You just have a ratio there. Both of them together are the highest ever if you combine them together. So I look at that and I think, okay, well, this is a problem. That's why I think part of the reason we did have a little bit of backup, it was CPI came out a little bit weaker than expected. And if you looked at S&P 500, it was actually down in April. So the correlation between very high stock market as far as GDP and inflation and everything now is probably the highest it'll ever be in our lifetimes.
So when you said, I mean, I'm just bringing up the Fed watch tool here, and basically what we're pricing in is 2 rate cuts this year. Now you mentioned that the Fed can't cut rates, but do you mean just significantly? Like, you think they'll do a couple mercy cuts just because they've been kind of promising that? Because even Jerome Powell earlier this week was basically saying, he still expects to cut this year. So what are your thoughts on that?
Headline on the tape is the Dow Jones Industrials printing right around 40,000. Massive, pretty significant run-ups in equity markets, in speculation in meme stocks, in cryptos. Is
Yeah.
an environment for the Fed to add alcohol to the punch bowl. It's just not the way it typically works. It's just be considered somewhat irresponsible. And let's look at the lessons of history. We're at the stage now for the Fed to ease. We need to see, I think, pretty severe signs of deflation or disinflation because of the lessons we have learned. According to what Jeff Booth tells us, we're all about error correction, and that is way too much liquidity and too much inflation. That's been the biggest problem in the last 2 years. If they start cutting too early, it's that lesson that we all know. This is what's different this time. Rates went up on the escalator, probably going to go down on up on the elevator, go down on the escalator, and it's going to take a while. So I think the beginning of the long slog's happening, and you're seeing it in things like the yield curve. I see it in things like the leading indicators, inverted curve, and declining demand for diesel, unleaded gas, and containerboard. All these key things are pointing to this is just starting to roll over.
So Scott, I mean, I know you travel a lot. Are you seeing any signs of like, I mean, I guess you're in a zone where crypto's been at all-time highs, or at least Bitcoin is. So maybe you're not seeing it, but are you seeing any slowdown on any of the traveling in terms of spending, or it's crypto, so people are just going nuts?
It's not just crypto. Every airport is crowded. Every airplane is full. Every highway in Florida is completely backed up, and you can't go anywhere without having double the time that you planned for. I don't know if they're doing it on their credit cards. I don't know if it's only the wealthy, but people are spending money like there's absolutely no tomorrow. And maybe to Mike's point, there isn't. Hard to know. But what I can say is that no matter what we think might happen, SPX made a new all-time high yesterday. QQQ, new all-time high yesterday. Dow Jones touched 40,000 for the first time in history, made a new all-time high yesterday. Dollar seems to be rolling over. Even in all of this, gold kind of breaking out again yesterday. I mean, blue sky breakouts are a trader's wet dream, and we've got them across the board in everything not named Bitcoin, actually. So at the moment, bit hard to fight the chart, in my opinion.
No, I agree.
What Scott said, though, is all part of the reasons why it's still silly to price in the Fed ease, which we know they started pricing in 100 basis points at the beginning of 2003. We got 100 basis points, 100 basis points of hikes. So what Scott just described is not an environment. I remember it well in 2001.
Rate cuts when every market is at an all-time high would be literally insanity.
Yeah, well, that's where we go.
So then what you guys are saying is the stock that investors are crazy. They're to expect it because the market is no doubt expecting cuts later this year.
Also, the Fed is fighting the Treasury, right? So we have this sort of unique situation where everybody is focused on monetary policy. Everybody's watching what the Fed does. When will the Fed cut? Meanwhile, the Treasury is aggressively easing, and we're actually seeing an increase in M2 money supply year over year. So there is liquidity coming into the system. It's just not coming in the way that everybody's paying attention to.
It's insane, man. I just want to bring this up and get your comments on it. But this is I wrote an article about the Fed increase. Basically, the Federal Reserve of New York came out with a report on debt and delinquencies, and they said an increasing number of borrowers missed credit card payments, revealing worsening financial distress amongst households. They have delinquency rates jumped 3.2%, now annualized to 8.9% for credit cards and 7.9% for auto loans. And so I guess this is where the dichotomy is, right? Where things are just weirdly getting messed up. You have assets at all-time highs, but there's a core group of citizens in the U.S. that are just getting smoked here. And so, how does the Fed even handle it?
It's not even a core group. It's everybody who's not in the core special group. It's everybody else.
And what was the main thing that really pressured the core group? I used to write a column called Joe Sixpack and say most of my family is Joe Sixpack, and that is inflation. Inflation was a big bugaboo that we cannot take the risk of returning. That would potentially destroy the current administration if we have inflation pick up. So that's unlikely. But I want to show you key things in shorter term, what matters too in markets, and that is when you get a little bit stretched. So what I'm showing on this chart here is, this is a wonderful situation when beta is going up, but here we are. We just take the S&P 500 versus a 100-week moving average, and we're there. Do you want to buy there? I'm like, yep, good luck with that one. That's when you're supposed to be saying, okay, I'll buy a little gold. And that's what I just overlay here with gold versus crude oil is breaking out. And the same, just another sign, beta. It's not only expensive. This is just a 100-week moving average going back almost 20 years. Let's take another indication from this, and that is volatility. This is what I show you in white. This is a VIX volatility index. I'm taking a 20-week average. I showed you this before. You subtract out the T-bill rate. It's a very significant competition to holding stock market, and it's the lowest since, well, that signal I got in 2006. It lasted a long time, but these are all the things that you look at and say, okay, I don't want to be overweight the equity market. You find alternatives. And same time, I also like to show is the China 10-year note, the China 10-year notes collapsing versus the U.S. It shows that deflationary bent from China. And I like to keep points that, for the traders involved, what we're seeing here is China's hitting towards a significant depression. And what BYD is doing to Tesla, what Huawei is doing to Apple. This is just getting started on a global basis. So that's why I like to open the global macro, and then I'll just tilt over the one final chart. And then there's Bitcoin. It's not keeping up with beta lately. And that's what I'm worried is. That's why I keep talking about beta, because it's got to keep going up or all the dominoes tumble. We only had one little bitty 5% correction. We haven't had that 10% correction, which always happens in bull markets.
Yeah, and I wanted to bring that up, and I think that's a really interesting point is, number one, Bitcoin, you're right. With stock market at all-time highs, we're seeing Bitcoin still consolidating, but I agree with you, like it should be pushing up here pretty soon, and it did yesterday, so maybe it can continue the momentum. But Scott, one of the things, like, so I followed GameStop, and I'm sure everyone knows what's going on there, and then AMC, and then today, I mean, there's like literally Wall Street Bets is just pumping and dumping nonstop. But the altcoins really aren't doing anything. And I really was surprised at that, because I'm like, dude, this is exactly the small cap, micro cap pump and dumps is like exactly what a lot of these altcoins are, but they're not moving. And I was curious if you had any insight into that.
I do. That's because within the altcoin market that are small cap pump and dumps, there are extra pump and dumpy small caps that are actually moving. And that's things like Pepe, which made an all-time high yesterday. Retraced a little bit today, but the meme coins that you would expect to go flying when GameStop goes flying after 3 years largely have. So we are seeing this movement very specifically in meme coins. Certainly not saying that that's a good sign or that that's any sort of signal, but it's been this sort of barbell in crypto where you have Bitcoin on one side, which has been led by the halving and ETF narratives. It made an all-time high ahead of schedule in the schedule, right? That's one side. If you've been in that, you've done exceptionally well. If you've even dollar cost average held, the other side has been the furthest edge of the risk curve. And everything in the middle is kind of still down 90-95% from last cycle, right? So the idea that we've had this massive alt season, things have moved, it really hasn't happened. There have been these little cyclical pumps, AI narrative or RWA narrative that last a week or two here and there. And then the meme coin casino going absolutely nuts. And that meme coin casino is a signal to Mike's point generally. And it was the signal actually when it was really heated up that Bitcoin was topping at 74,000 to me, or at least at the time that's what I said. So
yeah, and I remember that. I remember you saying and tweeting that this is not the sign of an altcoin season starting when you have the insanity that we were seeing before, and you were right on that. And then just drawing that parallel to what we're seeing in the stock market with GameStop, AMC, and all these others is it's probably closer to the end of the stock market. I mean, even though we're making new all-time highs, it may be short-lived, and we could see a reversal back down.
I think that it's really interesting, though, that all it took was one completely unrelated random tweet from Roaring Kitty of a guy sitting up in his chair and paying attention for that all to fly. It shows you how many people are just waiting for any opportunity to gamble in this market right now.
And I think gambling is the correct term there.
This is the like high pitch of speculation that generally does not end particularly well. But I mean, right now you can ride the wave. I did want to point out one thing, because if we're talking about that barbell, we should take a look at Bitcoin and what these ETFs have meant, because 13F filings have finally poured in for the first quarter. This is from my newsletter, but this is a very non-exhaustive small list of the people that have added Bitcoin to their balance sheets or who are holding these via the ETFs. If we wanted to talk about institutional adoption, Susquehanna, $1 billion, Boothbay, $150 million, Millennium Management, $2 billion, Morgan Stanley, $234 million. These are not necessarily huge numbers in a vacuum, but this is a lot of Bitcoin ETFs being added to the balance sheets. And you may have seen $100 million by the state of Wisconsin, their pension fund. It doesn't get any more conservative than the pension fund of a state.
That is a trickle. You can show my screen too that Saifedean Ammous predicted in his book, the Bitcoin Standard, that central banks will eventually buy Bitcoin. I remember reading that, and I think in 2018, I thought, no way. And it's nothing like I learned in life and markets. There's no zealot like a convert. Just to confirm what Scott said, it's happening. I completely agree with that. You're seeing it. But to me, as significantly as this headline is, Futures Exchange CME plans to launch Bitcoin trading. To me, that was what sparked me in 2017. Once you bring in the futures, trading futures on the CME, first start of CBOE, was the beginning of the mainstreaming of the market. That was 2017 at the end of the year. Now it's at the point that you look at this is still the quintessential trading vehicle on the planet, 24/7. There's nothing even close, 24/7. But now, and it's the ARB. Traders aren't always looking to get long and have their get long, buy low, buy and sell high, but it's the ARB. And they are be able to do between cash and futures on one exchange. And the key thing about that is it really reduces your margin costs. I mean, if you can do it one prime broker, and it's ideal. So that to me is just part of Bitcoin just going in the mainstream. We should continue to see volatility get squashed towards that of gold. It's still 3 times that of gold in the S&P 500, but that is this is sorry for the people who got in early on. It was good for them, but now it's completely mainstream, and it's solidifying my view that it's one of the most significant leading indicators on the planet now.
That's amazing. It is important to see. So going forward, like let's talk about price action here, starting with Bitcoin, Scott. You're still seeing consolidation in the charts, I assume? I mean, that seems like what we're doing. We're just kind of chopping sideways. Are you seeing any signals that we could be getting ready for a move higher here soon, or is it more of the same likely?
More of the same. In fact, if you had to ask me from the way that I chart and the signals I look for, I would say we just had a gratuitous top here at the sort of middle of this range. And that's because RSI was massively overbought on the 4-hour with bearish divergence. I know it's astrology for men, but that's my signal, and it was there. So if you were looking yesterday, I would have said we're at the range lows. We popped right up to the center of the range. Why? I don't know. CPI data, jumpy traders. Every single day, we're going to the moon. We're going to zero. We're going to the moon. We're going to zero. I've never seen such schizophrenia in the crypto world. The reality is, if we're between 60 and 74, we're chopping sideways, and that's it. There's nothing happening. Literally nothing happening. If we break above 74, we're bullish. If we start really closing candles down in the 50s, we're probably pretty bearish. And that's about all I've got. So, otherwise, this is just the same boring sideways 4 to 6 months of death by 1,000 board cuts that we see every single halving cycle.
And you mentioned the CPI data, whether or not that was the catalyst. It obviously seemed like it was, but I would just like to point out is that, you had 3 CPI prints that were higher than expected. And so it basically put the bar at, hey, just be okay and not horrendous in terms of inflation, and people will be relieved. And that's basically what it was. And I just like to point out to people is that month over month, it was 0.3%. If you annualize that out, it's still 3.6% inflation, which is not good. I mean, it's not even close to the 2% that the Fed wants. But the markets loved it yesterday, and we made new all-time highs across the board. So, I mean, I think people just I think there's some sort of animal spirits, if you will, or melt up, as they call it, in assets right now, where people are just looking for anything positive to get money to work. And I do think that logic will prevail eventually, and people will say, wait a minute, this isn't the scenario that can be sustained for the long term.
Well, we've sat through many of these before. I remember going through the pain of that in 99. I'll show you a few charts, and then 2007, because it was way early. But that's what I like to show you here. It's just, we're so far above the 100-week moving average. We have on a 100-year basis, if you look, these two measures, S&P 500 versus gold and GDP, both to combine, these measures as the most expensive ever. And then you look at things like the inverted curve, and that's what else I want to show. And this, the volatility. This is one thing I really am afraid of is the extreme low in volatility. Which one was right there? Extreme low in volatility. It's just all those warning signs, but these things can last for a long time. And that's why I think part of what you're seeing is that allocation towards Bitcoin and gold. And I'm looking at still TLT and long bonds that by the end of this year, we're going to see a big pump higher. When you just get a normal, here's the key thing. I'm just looking for that. We had a quiz. We had a quiz in the market. Beta backed up 5%. And who failed? Crude oil completely failed. Who won very well? Copper. We can talk about that in a second. But Bitcoin did fail. S&P dropped 5%. Bitcoin's still below that level. Now we're at all-time highs. Bitcoin's not doing it. It's the 10% correction. We need to get through that test. It'll happen. In the meantime, it's a great trading environment, but I think the smart money is just using more like derivatives to be involved in the equity market. And that's why we're seeing right now is a lot of this has been short covering.
Yeah, and speaking of which, you just mentioned copper, and I think it's important to take note is you had an amazing run in copper where from the start of this year, I think copper is up about 35%, but it does look like we maybe topped out, at least in the near term, with a double top going back to the highs of 2022. And you can see again, we flushed up. It almost looked like a blow off top to me because it pushed up in the overnight a couple nights ago and then reversed here. But I assume that if copper's topping, that's a negative for the global economy, right? It shows that potentially demand is dropping. And then same thing on oil, Mike. I know you look at oil a lot, and I think, Scott, you do too. And basically what I'm looking at in oil here is you have this trend line, and we're now bear flagging right against that trend line. And if this breaks, oil has a big move down in store. So I think that's something interesting to point out as well.
So that'll be on the tape tomorrow. Who passed or flunked the 5% beta backup quiz? Copper passed, oil completely flunked. And here's why I show you similar chart on copper, but I overlay it with managed money net positions. This is both on CME and LME, and these are basically hedge funds in white. What that is basically shows you that the spec longs are the highest, about 30% of open interest since right around the top of the bull market in 2021. So the market was way over long, but what you're seeing happening was like there's shenanigans in the rolls. The front contracts, we had some shorts covered in copper and squeezed out in CME versus the backs, buying those back and versus LME. But here's another thing that's really good signals. This reminded me of silver in 2011. I was at S&P, and I remember looking at it very closely. For a very rare occasion, silver very rarely goes in backwardation, particularly when rates are positive. It did. And this is what just happened. I show you the 1-year curve on copper. It popped to the highest since 2008. It's a very positive year. At the same time, the prices are rallying. So the front markets, there's some shorts got squeezed, pumped up to all-time new highs. And my prediction is copper got to around 5. I can just look at, okay, what's next, 4 or 6? Copper is one of the most autocorrelated commodities. I think it's much likely to go back to 4. Didn't go to 6. And then I pointed out all those bond yields are collapsing in the rest of the world. If you just look at bond yields in China, that's a good sign that copper's got a problem.
What, Scott, in terms of do you follow silver much, or you obviously follow gold a little bit, but I know silver's been hammering on that $30 level. I mean, do you have any views on the commodities that we're kind of mentioning here?
I just find it really interesting that we're seeing metals fly. I mean, there's obviously the silver chart. I mean, I had this triangle pinned for ages. Obviously, it broke out sort of at the beginning of April, right? So silver looking extremely bullish from a charting perspective, following gold to some degree. But I find it really interesting that we're seeing new all-time highs in gold stocks over the past few weeks. Right. Silver trailing. Maybe it's not a new all-time high yet by any stretch, but still breaking out. It's not supposed to happen like that, right? You're not supposed to have the safe, hard assets that you flee to in times of stress and the beta rising at the same time.
There's good potential correlation here. First of all, we know the most significant buyer on the planet of gold is China, not just the central banks who has the ability to print rates. You can see the plunging yields. This is mostly led by China, but it makes sense that they're hoarding other metals. The metals are the best storables, particularly potentially copper and silver. Now, I don't know that for sure, but the signs are all there that they're also, I mean, why would they just take the risk of just holding gold? And that's why I always tilt over, well, how about some Bitcoin too? But, you know, they're looking for physical assets, anything to get away from the dollar. Metals are first, and any other commodities, forget it. You can't really hold them like metals can. So there's that there. And that, to me, it's that unlimited friendship between Xi and Putin, who's been hooking up this week. It's in Mr. Putin's trip to Beijing and reiterating that friendship. That is a significant, to me, one of the most significant global macroeconomic things that's happening. And it's part of the reason that the world is, when people say deglobalization, I say it's not really deglobalization, it's GMTFO of China. Get me the heck out of China from a US and importer standpoint and do business standpoint.
Yeah, I was going to mention that. I think that the at least the markets and investors have really forgotten about some of these risks, like geopolitical. They just write it all off, whether it's Middle East, whether it's China and Taiwan, or whether it's Russia and Ukraine. It just seems like it's totally been written off. Let alone the U.S. election later this year, as if no one's worried about it whatsoever. And that's just to talk about geopolitical issues, not to mention the economic factors. It's almost like the market and investors believe that like literally the world could end, but as long as the Fed is there to print us out of it, it doesn't really matter. And I think that's a really scary thing, at least on a potential catastrophe scenario, to be in belief of, you know?
So I think that's the key thing. You see that in bond yields, which I show you here. And to me, that's what's happening. A lot of the smart leverage money are shorting equities, and that's kind of a tough game and getting hurt. But at some point, that's the shoe to drop. Is we've only had a 5% correction, but everything tilts on. At some point, when we get that next, I didn't say if, next 10% drawdown in a bull market still, all the dominoes are falling, tumbling. Now, it's already starting in crude. We had it in natural gas, it's somewhat not related. We're getting it in grains already. It's deflationary dominoes, and it just ignore global bond markets at your peril. And I think that's what the smart leverage money is doing. Is they're playing for that next the big move's going to when we have the correction in the stock market. The U.S. I'm sorry, in beta.
Do you think that people, investors, have been conditioned at this point where you know, every time we pull back, I think the last pullback on the Nasdaq was 8%, and the S&P maybe was 5%, but then it right back to new all-time highs. So are you guys expecting in the next, let's say, 6 months that there could be a pullback that does not bounce like everyone and kind of catches everyone
at some point? That always happens.
Mm-hmm. Now would be the time to do it, by the way. If you believe in the election cycle, and now would be the time to let the rug pull for a little while, take the beating politically, and then
come back strong,
back up in September and October leading up to the election. Right. So I wouldn't be surprised to see a down summer.
But I think that scenario is a matter of time, Gareth. But just look at the biggest correction we've had since 2009 and 11 in the U.S. S&P 500 was when we dropped 25% with COVID. Mm-hmm. At that same, but remember what happened then, and there was a good reason for that to happen. It bounced right back up. We threw all the liquidity again. When people are, it's just human nature. It's been over a decade now, and if you're not in it, you're falling behind. And we're at that stage now. It's the blow off top. But the key thing I need to point out is Bitcoin dropped 80% during that move, and that's the thing you still have to worry about. Risk assets is in the long term. I completely agree with it, but in the shorter term, it's this overlay with beta. Beta goes down, that highly risk assets have a problem. I think there'll be initially buying, but we all know Bitcoin's going. There's going to be more. There's going to be a bear market. We haven't had. Let's put it that. We haven't had a bear market since 2009. We're overdue for a couple years. It's just, and how does that happen? You typically have great signs like leading indicators and retail sales. And
was
stuff
2022
like that.
not a bear market then? I mean, you don't consider that to be a bear market in 2022?
Well, I mean, a couple years. That was a 25% correction, right? Okay, and
so you're talking like the bigger one, the 50% or kind of.
Well,
thing.
50% and things that last more than a year.
Yeah.
I mean, bear markets that I remember would last a couple of years.
Yeah.
Particularly after the
that must
dot-com
mean
bubble.
You're pretty old because we haven't had one of those in a long time.
Exactly. And then you get to a point where things are so expensive, like here, most expensive in 100 years by both of these measures. You have to say, okay, you're just looking for signals. And that's what I'm looking for. You're looking for triggers and signals and what's going to make it start tilting over to normalization. And that's why I still lean towards, okay, that TLT and long bonds at some point, they're probably being pretty good. And I look at, these plunging yields in the rest of the world. They're just going to, the U.S. yields are just going to catch up to the rest of the world. The rest of the world catching up to the U.S., unlikely.
Yeah, and I'll show this just as before we end here, but here's my TLT chart, and look at this view. This is a perfectly parallel channel, right? And look at how we've just been chopping sideways, but look what's happening. We're borderline getting a breakout right here on the TLT. So I'm in your camp. I think that it's not so much the Fed lowering rates as much as the economy starting to send more and more signals that we're slowing very, very quickly. And I think that sends this TLT, which basically means rates go down much, much higher. So
is it at about the most maximum disdain I've seen in my lifetime in the bond market? Yes. And I started trading bonds in 1988 in Chicago Board of Trade.
Amazing. All right, guys. I think that's a great place to end on this Market Mavericks Thursday for 3 p.m. Are we all good for next week again? I love asking and putting everyone on the spot.
We'll be here.
All right, guys. Thank you all for watching. Thank you, gentlemen. Follow at the bottom there. You can see the socials, and we will be back next Thursday at 3 p.m. sharp. Have a great one, guys. Take care.
Thanks, guys.